We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always go to the website to learn more about Brian, Arrin, and the team. It's deckerretirementplanning.com, deckerretirementplanning.com. And I always start with this. If you have an opportunity to go to that website under the heading of Safer Retirement Education, you can pick up Brian's book. You can download any or all. There's like 12 different things to download, but one of them is Brian's book on retirement, the Decker Approach book. There's a 3 Principles of Retirement book. There's a checklist challenge. There's a sample income plan. That's just a third of what you can download on the website. There's no cost for it. It's just there for your information. And then maybe you'll have some questions after you pick some of that up. You can always call the team. 833-707-3030. No cost to you. 833-707-3030. Brian, Arrin, welcome to the show. And Brian, you're going to get into something that seems to me to be kind of important when it comes to retirement planning, and that would be having retirement income.
Yeah, having multiple income streams, Mark, is really important because it's a function of a properly drafted retirement plan. There's an identification of use of funds for every part of the portfolio. So, Arrin, for example, emergency cash is going to be invested differently than long-term risk. Talk about the liquid funds, what would need to be liquid.
Yeah, I think to start from a foundational level, what we want to first illustrate is what the actual purpose of the money is. So you have your working career, 30, 40, 50 years long, however that ends up being time-wise. And during that accumulation period, the goal is just to build up that asset base, right? Build up your nest egg. You want to work, save, put money into those retirement accounts, have those grow. But eventually, there comes a point in time when you actually want to use that money, right? You're not just looking to see your account balance go up. The point now, or the priority now, is more about, hey, how do I take all of this hard work that I put into building up this asset base and actually put it to good use, actually get some value out of it? So at that point in time, you do need to diversify into what that money is invested in, shift out of some of those more volatile or more aggressive type investment allocations and into things that are going to more closely align with the goals that you have for the money, right? Protecting it, making sure that it lasts as long as you need it to, using it as income streams. The goals for the money shift a little bit. So that also necessitates putting it into different vehicles. So like Brian mentioned, we typically have a few different categories or classifications of investments just to make sure that every dollar is allocated a specific responsibility, making sure that you're not missing any of those pieces in retirement. So the first of those categories is going to be what we call emergency cash. Now, this is going to be a small cash account set aside for unexpected expenses. There always seems to be something that pops up. Your car needs a repair, water heater goes out at your house, whatever you got to just pay a chunk of money out of your pocket for. And so we recommend clients have a small cash account set aside. Now, dollar-wise on that can vary. Some people have pretty low things expense-wise that could pop up. Other people have a lot more things that they're worried about, or they've got a roof repair coming up, or they need to buy a new car. And so the dollar value is going to vary a little bit. But the goal here is to allocate a cash account where you have immediate access to it. So sometimes people will put their emergency cash funds in a specific bond or in laddered CDs. And although you might get a little bit better interest rate from doing that, you also have a liquidity problem, right? If all of a sudden you need to pull $25,000 out of the emergency cash, you might take a interest penalty or an actual principal penalty for early withdrawal from some of those time-based or fixed rate investments. So typically with emergency cash, we will recommend that it is in a liquid investment, meaning that you can have access to it immediately or within just a couple business days. And there's a couple different things that you can do here from an investment standpoint. Number one, if you want to go an ultra conservative route, you have the ability to use high yield savings accounts, money market funds, things that are going to be fully liquid, pay a moderate rate of interest. A lot of those money market or high yield savings rates now are somewhere around 3.5%, maybe 3.7%. We also have an investment strategy that we utilize here at Decker Retirement that's geared towards still keeping the money 100% liquid, but also getting you a little bit higher rate of return as some of those rates start to come down. So that's going to be the first one on emergency cash. Now, for the additional categories, again, we want to make sure that the funds are invested according to the goal or the responsibility that you've assigned to that bucket of money. So when Brian was talking about the 3-year money, 5-year money, 7-year, and so on, this is where we shift into the safe portion of your portfolio. So we call these principal guaranteed accounts. Their job is to protect the money, meaning don't put downside risk here where if the market takes a correction, you're going to be at risk of losing that principal. You want to make sure you're insured or protected against that. And then you want to use this money as income over time. So in retirement, you're going to have those multiple sources of income, right? You have your Social Security, you might have a pension or rental income or part-time work, but you're very likely going to be drawing money out of your retirement accounts, that asset base to live on. And you want to make sure that the money that you're pulling on a monthly basis is protected from the market. So those principal guaranteed accounts are laddered out, both to make sure that you have the ability to withdraw that money when it's needed, but also to make sure that you're getting the highest rate of return on those accounts as possible. Now, typically that's going to be the majority of the funds as far as percentage of total assets. And again, we call those the principal guaranteed accounts. Now, the third category, this is what we call the risk bucket. You can think of this as market or stock market investments. The goal here is to have a portion of the portfolio still slated for growth. Typically, retirement's going to be a long time, right? Hopefully, you're not retired for 5 years and then you're done. It's going to be 20, 30 years, depending upon the age and longevity. And we want to make sure that while that income is being provided from those principal guaranteed accounts, you have a separate account that's set aside, growing, building up that asset base again for use as income in the later years of retirement. So again, we call that the risk bucket, and its job is higher growth over a longer time horizon. So before we shift into some of the specific income streams, Brian, anything you'd add to the outlay on the accounts?
Yeah, we take our responsibility seriously about being fiduciaries to our clients and being a math-based firm. We want to know that our clients are getting the highest returns. So we use something called the WINK, W-I-N-K, the WINK database to let us know what the highest earning principal guaranteed account offerings are from banks and insurance companies. So when we look for a money market account, which by the way, the good news is it's completely liquid and it's very safe. You can't lose money. The bad news is it's a very low return compared to the other investments. So we want to weigh how much money should be in that account. Arrin, you couldn't know, I couldn't know. So being a math-based firm, we use a distribution plan, which is a spreadsheet that takes into consideration, this is big picture, all the different income streams you've got in retirement: pensions, Social Security, rental real estate, and your portfolio income. And then it takes in your portfolio income and breaks down how much mathematically you should have in this most liquid account. And that's what we call bucket one. So Arrin, anything you'd add to bucket one before we go on to buckets 2 and 3 and kind of drill down?
No, it's just geared towards making sure that you've got a readily accessible bucket of money to pull from right away in retirement, making sure that there's no liquidity restrictions there. Just get you off to a good start on those consistent income streams.
And before we talk specifics about buckets 2 and 3, which I'm really proud of, we stagger the maturities to minimize interest rate risk. And what that means is if you've got liquid money, you've got 3-year money, 5-year, 7 and 10-year money, if interest rates go down, you've locked in much higher rates. So you benefit from that. But if interest rates go up, you get hurt because now your money is locked in at a lower rate. So we do a combination of investments so that if interest rates do go up, you have interest rate risk protection on buckets 4 and 5. We don't put all our eggs in one basket, but talk specifics about, we covered bucket 1. talk specifics about the options that a client has for buckets 2 and 3.
So the goal for buckets 2 and 3 is to provide income, usually starting in the 4th year of your plan or the 4th year of your retirement. So a lot of the income is going to come from bucket 1 for that first 3-year period. And starting in bucket 2, that's where years 4, 5, 6, and 7, a large portion of that income is withdrawn from those 2 accounts. So usually what we'll do there is what's called a fixed rate investment for both buckets 2 and buckets 3. Now, for bucket 2, the goal is to be able to have that target a 3-year term. So we invest the money, allow it to grow for a 3-year period. It then matures. We use it as income for the following 2 years. Same concept for bucket 3, except this one's just slightly longer. So this is going to be a 5-year term versus a 3-year. And when we do the research on the specific option or vehicle here, like Brian said, we want to make sure that we're not only looking at reputable institutions, right? Something that's going to have a high credit rating, good financial standing, good reputation in the industry for treating their clients well, but also make sure that we're getting you the highest rate of return, right? So a lot of different vehicles offer fixed rates. You've got your banks and your credit unions that'll give you CDs. You have T-bills, you have bonds, you have things called MIGAs that are from insurance companies. So after going through that process of making sure that the institution is reputable, we then want to compare those different rates and make sure that we're getting you the highest rate of return that interest rate lock is possible. So this varies over time. Obviously, interest rate environments, what the Fed does, the economy, all of those things have a big bearing on what the rates of return are for those vehicles. This does have upside exposure. There's years where this portfolio might make 15, 16, 17%. But long term, when you're looking 10-year plus time horizon, it's averaged around 8, which is more than double the current rates of a lot of those money market or high yield savings positions. So it's a great way to be able to both give you access to the funds that you need for income, making sure that those withdrawal capabilities are there, but also giving you a lot of upside exposure as we have this uptrend in the market here.
So if you'd like to talk with the team at Decker Retirement Planning, it is an opportunity for you every week on this program because Brian doesn't want to charge anybody for any of this. It's really an opportunity for you to come in and find out where you are. You want to know about your income. Where's it going to come from? How much do we need month after month? And then how do we make sure it's there as long as we need it? This is the team to talk with. There's no cost for this. 833-707-3030, 833-707-3030. At the very least, you're going to get clarity into your situation, but you might actually find out, heck, I could have retired a couple of years ago. I could retire anytime I want to because I already won the game. Don't know. Brian and Arrin don't know where you are. That's why you have the opportunity to call them, ask some questions or concerns that you may have, and throw them out there. Let's see what they can do for you. 833-707-3030, 833-707-3030. We're just getting started with Brian and Arrin on Safer Retirement Radio. We are back with more about income. One of the key points to retirement is having income. We're talking more about it when we come back right after this.
Filing for your Social Security benefits is like trying on a pair of pants. You can't just assume one size fits all. Visit with Brian Decker and the team at Decker Retirement Planning to explore your options. Call 833-707-3030. Like your pants, it's important to find the right fit. That's 833-707-3030.
Remember that first paycheck when you started working all those years ago? You looked at the net amount and thought, whoa, what happened here? Ah, the joy of taxes. It could be this way with your retirement accounts. You know how much you've saved, but if you haven't planned for Uncle Sam, you could come up short in retirement. With tax laws constantly changing, there's a lot you need to know to make sure you're not paying more than your fair share. Financial advisor Brian Decker and the Decker Retirement Planning team can help you create a plan that shows you how taxes could affect you now and in the future. Set up your tax strategy session with Brian and the team at Decker Retirement Planning now. Call 833-707-3030. That's 833-707-3030. Make sure you know how these changes could affect you so you can avoid some of those whoa moments in retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can always go to the website to learn more, DeckerRetirementPlanning.com. You can pick up Brian's book there, by the way, the Decker Approach book. You can download it under the heading of Safer Retirement Education. But if you have questions, 833-707-3030. There's no cost, there's no pressure, there's no obligation, there's no judgment either. The team's here to help you if they can. 833-707-3030. I'm Mark Elliott, Brian and Arrin talking income today. So this segment, where are you going to head with this topic, Brian?
Well, we're going to wrap up something that was really important, which is the background of the strategy that gives it such a high return. Is completely liquid. Its average return in the last 5 years, several years, has been around 8%. And how did we create that, Arrin?
So we have an awesome team here that does a lot of work for us, both in the research category and finding different vehicles or investment strategies that are out there, also in making our own. So we have a number of different proprietary investment strategies, one of which is that Core Income Plus strategy that I mentioned before the break. So we have our risk and our research team here that put that together. A big portion of that was using AI or artificial intelligence. The tools for that have come a long way in just the last few months, the last couple of years, and we're taking full advantage of those to make sure that our clients are benefiting from the different advantages that are there, not only in what those funds are invested in, the actual allocations, the ETFs, the stocks that we're using, but the percentages, how we're rebalancing, the structure, all of those things are geared towards making sure that that portfolio is built specifically for that job that we've assigned to it. Now, with that structure, again, the goal really is to be able to both make sure you have access to the money and also make sure that you're getting that highest rate of return. And we found that to be very effective as we've had our clients use that for those bucket 2 and 3 accounts. Now, shifting over to bucket 4 and 5, this is where we get into the longer time frame accounts. So typically we define these as 7 and 10-year accounts. And the goal here, again, is to both have that money protected, but also make sure that we're getting the highest rate of return because these are going to be longer dated accounts. So some of the options that are available here, you have the annuity category, and this is a big world. So a lot of times when people think about annuities, what typically comes to mind is what's known as an income or a life annuity, where essentially what you're doing is you're taking a lump sum of money, you give it to the insurance company, and in return, they're going to pay you a set income stream, typically for the rest of your life. Now, you can think of this like buying a pension, right? You're trading that lump sum for a set income stream that comes out monthly. Now, we don't typically recommend income annuities here at Decker Retirement. And there's a couple different reasons why. The first is that you don't have a lot of control over the money. So once you turn that lump sum into an income stream, or what's known as annuitizing or turning on the income rider, you don't really have control of the money from that point in time forward. You do get that monthly amount, whatever the set income stream is, but you can't take it any faster. If there's an emergency, it's not like you can take a massive lump sum out of that. It just kind of locks in those funds into that specific income structure. Now, the second, from a growth rate standpoint, we are very mathematical in the way that we do our research, present our recommendations, put together the financial plans that we build for clients. And we want to make sure that that protection is there and that you're getting the highest rate of return. Now, as a trade-off for those income annuities, that set income stream that you're receiving typically means that the growth on those is not going to be great. The rate of return that you're going to have on those is going to be significantly less than you could have from other protected instruments. So there are other categories of annuities, specifically MIGAs, which stands for multi-year guaranteed annuity, or fixed indexed annuities, or FIAs for short, that are geared more towards protecting that principal from loss, meaning no market exposure, no downside risk, but also give you a lot more control over when and how you pull the money out as far as distributions And the growth rates that you're receiving on those are considerably higher than what you would get from those income or life annuities. So when we're looking at those FIAs specifically, those fixed indexed annuities, they do have a variable rate of return. And the average that we're seeing right now is upwards of 7 or 8%. I mean, we've had clients make 18, 20% in a year on these. We've seen them hit lower than that. But on average, where we're looking at 7, 10, or longer year time horizons, you're going to be looking high single digits as far as the rates of return there, which, especially as we're heading into these volatile market time periods, you're looking to protect that money. You're looking to get consistent or stable income out of it. These are phenomenal vehicles to be able to accomplish those purposes, those responsibilities that we've assigned to those accounts there. So, Brian, what would you add to that?
Oh, just that we'll talk about the liquidity there too, and the fact that we really would not dwell in any other annuity space. We don't use variable annuities, income annuities, life annuities, income riders, and even on the annuity, the fixed indexed annuities, we would steer away from any ones that have caps, like capping or limiting the rate of return, the performance, or the high fees. We would stay away from any of those. Because we're a math-based firm and we use the Wink database, we can see what the highest return principal guaranteed accounts are for money markets for 1 year, 3 year, 5 years, 7 and 10 years. And we use that data to best help our client. But talk about the liquidity there, Arrin, how we take liquidity, very important for the selection in bucket 1, 2, 3, 4, and 5.
Yeah. So before I jump into that, I want to just elaborate on one point there you mentioned is fees, Brian. And that is a very important piece of this, that at the end of the day, what matters most to you as the client is how much you actually get of that money in your pocket, right? And if you've got annuities that are charging you a 1% fee on this rider, and there's an upfront fee, and you've got this extra garbage tacked on, it ends up not being a very good deal for you. So the way that we structure any of those types of fixed indexed annuities that we help put into place is there are no upfront fees and there are no annual or ongoing fees. So that's one of the big concerns, the big questions that we typically get is, hey, what am I going to have to pay for this? So the insurance companies do make money off of managing those assets for you. So implementing them the way that we recommend here at Decker Retirement keeps more of that hard-earned money in your pocket where you're not getting assessed those rider or those additional income fees. So on the liquidity portion of it, this is something that we take very seriously because we want to make sure that not only do you have the protection in place, but you also have access to the funds when you need them, right? I mean, from a very simplistic standpoint, technically you could just do a CD or a bond ladder, right? You could do 1, 2, 3, 4, 5, 6, 7, continue to structure them out. But the problem with a lot of those account types is you don't have any access to the money, right? If you need funds out of that specific account, you have to cancel it, take a surrender or an early withdrawal fee. And so with the structure that we have, the bucket 1 through 5 structure, we make sure that the liquidity is there where both you can have the access to the funds that you need and you have those assets protected. So the liquidity profile of each of those vehicles is going to be slightly different. Again, you've got the money market, the core income plus strategies that are fully liquid. Those MIGAs or fixed rate options are going to have those liquidity restrictions where you need to leave them in for that set time period. Now, when we're looking at the buckets 4 and 5 accounts, a lot of times those FIAs or other what we call partially liquid investments, usually the way that those operate is you have a 10% per year free withdrawal. Meaning if you put $500,000 into one of these products, year 1, you can pull out $50,000. And then every year thereafter, during either that 7 or that 10-year liquidity or surrender schedule, you have access to 10% per year that you can withdraw without any fees or early termination penalties. So what it really does for you is it allows you to be able to get more money into those accounts because you have that liquidity. And where those accounts are a little bit longer, they are going to have a higher average rate of return for you based off those 7 and 10-year profiles there.
So we have about a minute and a half left. So here's a question for you because I don't have a pension. A lot of people don't have pensions. So a fixed index annuity is going to give me some of the growth, but I have none of the downside. And a lot of people are using those as a pension, like, get a check from that fixed index annuity. Why do you dislike that?
Yeah, there's a couple different things there. The main goal of providing retirement income is to have it protected and have it consistent, but you also want to make sure that you're getting as much value out of those assets as possible, right? I mean, on a very simplistic standpoint, technically, you could just stick everything in the bank and pull from your savings account, right? It's safe, it's liquid, but you're not really going to have that money growing, especially where you have a long time horizon in retirement, 20, 30 years. You do absolutely also need the growth to be able to make sure that that is going to provide the income that you need. And we're also very focused on inflation protection, right? That's been a big topic in the news recently. Inflation started to tick up again. We're seeing a lot of those core staples of expenses increase. Gas has gone up, food has gone up. A lot of those other normal everyday expenses have increased. And with those income annuities, most of the time they're set up to be a static value, where if you get an amount coming out, it's $2,000 a month that they're paying you. Yeah, that might be okay now, but what about in 5 years or 10 years or 20 years? That $2,000 a month isn't going to go as far as it used to, right? I mean, my dad will tell me stories. Hey, when I was a kid, you could go to the store and for a quarter, you could buy a soda, a candy bar, a sandwich, all of this stuff. And I'm like, who carries quarters anymore? That doesn't pay for anything nowadays. So inflation protection is a big part of it, just making sure that that money is going to keep pace and exceed inflation. And with those income annuities, they do a really good job providing consistent income, but they're not great at helping you maintain that purchasing power over time. The other thing here that a lot of people miss is, especially if you have a focus on legacy or inheritance, you want to pass the money to your kids or other beneficiaries. Once you get past typically about 10 to 12 years into an income annuity, there is no longer a residual death benefit. You've depleted that account balance. You do still get that income stream coming out, but you don't have the ability to pass on any of that money should you pass away then to your kids or your children. There is no residual death benefit at that point in time.
So if you have questions about annuities, are they right for you? Or are they wrong for you? Because Brian and Arrin and the team at Decker Retirement, it's really about you. What do you need? Do you need stocks, bonds, mutual funds, ETFs? Do you need life insurance? Do you need annuities? What do you need to put you in a better position? That's what they care about. If you'd like to learn more, it's 833-707-3030, 833-707-3030. Great opportunity to get some clarity into your picture. 833-707-3030. Arrin and Brian back with more Safer Retirement Radio right after this.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, the website, deckerretirementplanning.com. Find out more about the teams, offices, where they are, all that information. But you can also go there under the heading on the website, Decker Retirement Planning. There's a heading of Safer Retirement Education. There's about a dozen things you can download. Checklist challenge, sample income plan, 3 principles of retirement book. Brian's book is there as well, Decker Approach. So there's a lot of information on the website, and it's all there for you want to download you want to download all of it. It's certainly your opportunity. There's no cost to do so. But if you have questions, we're talking retirement income today, and Aaron's going to get into Social Security. How does that factor in? What about pensions? Do I take the lump sum or do I take the pension the way it's designed? He's going to get into all of that this segment. But it's 833-707-3030. If you have questions, you want to learn more. Because really, at the end of the day, when you're listening to shows like this, it's really about, okay, well, how does that affect me? That's what I want to know. What about my family? And that's why you certainly call them. 833-707-3030. All right, Arrin, Social Security, it's a foundation in that income strategy, certainly, because we're all going to get it. And then, of course, Brian said that the government needs to use Social Security for many other projects, so they're going to tax me now on it. I'm not happy because I just started, by the way, last month. Social Security has started coming in my way.
Well, congrats, Mark. So Social Security is important to be able to nail down because it is going to be a chunk of the income that you'll receive during your retirement years. Now, one of the mistakes that a lot of people make is they look at Social Security on an island by itself, meaning they look at just that Social Security income stream without integrating all of their other financial assets, right? If you have rental income, a pension, you've got retirement assets that you're going to be withdrawing from for income, you want to make sure that the way that you're taking Social Security or the timing of that works cohesively with the rest of those pieces of your financial plan. So when we look at Social Security, we want to make sure that we're looking at it when it's going to be the best value for you while it's integrated into the rest of your income and your assets. So here's a few things to consider when looking at Social Security. Number one, if you're married, you want to make sure that the timing of when both spouses draw Social Security is going to give you the most value. So here's a couple things to consider here. Number one, a lot of our clients have one spouse or the other that's been the main breadwinner for the family. And that oftentimes means that the other spouse is going to receive what's called a spousal benefit. So this is your ability as the spouse to receive a Social Security income stream based off the main wage earner's income. So when you're looking at this, there's a couple qualifiers for that spousal benefit to be turned on. First, that main person, the one that does have their own individual Social Security benefit, has to have started their own. So it's not like you can start your spousal benefit before your spouse has taken their own. So that's going to be the first thing. And the second is timing of when to do that. So oftentimes our clients have an age gap between the two spouses, and you want to make sure that with the integration of both the age gap and the way that spousal benefit operates, that you're starting that at the time period that's going to give you both the most value out of that income source. Now, shifting to just individual benefits, again, you want to make sure that you're getting as much out of this as possible. So as many of you may know, you can start Social Security at age 62, in between 62 and what's called your full retirement age, which is typically around age 67. The annual increase in Social Security benefits is 5% per year, prorated monthly. Now, in between your full retirement age and age 70, that increase jumps to 8% per year. So you get a little bit of an extra bump going from 67 to 70. But waiting until age 70 to start your Social Security benefit typically means that you have to live a little bit longer to break even, right? So if you started Social Security at 70, you only lived up 74 or 75, you kind of got the short end of that stick. Whereas if you live to 90, 95, 100, that very much worked in your favor. So one of the things that we can do here is run what's called a Social Security timing report. And this is a software system that allows us to be able to show you what the optimal strategy is for you and your spouse to be able to take Social Security. And again, we integrate that with the financial plan, the income distribution plan that we build for you to make sure that that's going to work well within that foundational structure of all of your income and your assets. So a couple of things to note about Social Security. One, you do not want to take it before age 67 if you are still working. So sometimes people will say, hey, I'm 62, I can take Social Security, I'm just going to do that. But they've got a job, they're making $100,000, $150,000, $200,000 a year, and they don't realize that starting Social Security that early while they're still working, bringing in a good wage, reduces the benefit that they're going to receive from Social Security. So in this year, 2026, the limit for income is $24,480 before your Social Security starts to be reduced. So you can have a part-time job, can make a little bit of income. But again, our typical recommendation is that you should not start your Social Security income until either your full retirement age when there's no income limits, or until you've fully retired, just to make sure that you get as much value out of that. You don't have any problems where you're supposed to be getting $3,000 a month and it turns into $1,000 because your job is providing so much income at that point in time. So, Brian, anything else you'd add to Social Security?
We're a math-based firm. We want to maximize your Social Security benefit.
Yeah, and on that note, one of the other things is, as far as delaying benefit, getting the higher benefit at age 70, the surviving spouse, when one of you passes away, does take over the higher of the two income benefits. So, for example, I had a client last week that I was talking to. They were thinking about starting their Social Security at 67, but their spouse is 8 years younger. And so I was like, hey, you may want to consider waiting until 70 when your benefit's going to be as high as possible, because it's very likely that you're going to pass away. Your spouse is going to receive your higher Social Security value, and where she has a much longer lifespan, statistically ahead of you, you want to make sure that she's going to get as much value out of that should you pass away first. So again, there's a lot of moving pieces to Social Security, not only in and of itself, but in how it's going to interact with your plan. And that's what we do here at Decker Retirement, is make sure that we're taking all of those different variables into consideration when we're giving that recommendation of when you and your spouse should pull that specific income source. So shifting over to pensions, let's talk a little bit about both lump sum and income stream pension options. So we work with a lot of different clients that have pensions through a private employer, state government, teacher's pension, whatever the source may be. And most of the time, they're going to give you a few different options when you're looking at how you can receive that benefit. Option number one is going to be a lump sum. So they say, hey, you've retired, you've accrued this amount, we're willing to pay this to you as a lump sum and just be done with it at that point. The second option that has a few different subsets is going to be an income stream. And typically they'll have like 4 or 5 options underneath this parent choice, where you can take it based off of just your life. You can have it as 100% survivor benefit, 50%, 25, whatever the percentage benefits are that continue should you pass away first. And then sometimes they do also give a partial lump sum and a partial income amount, kind of splitting the difference between those two. So here's some things to consider when looking at what the best pension option is going to be for you. The first, I'll just say this outright, most of the time, high majority of the time, it's going to be better for you to take the lump sum option than it is to be able to take the income stream. I know sometimes the income stream feels safe, it feels secure, it's nice to be able to have that in your back pocket. But here are some of the drawbacks with taking the income stream versus that upfront lump sum. Number one is a long break-even period. So the math on these is going to differ based off of the specific options that you have. But a lot of times what we see is, even assuming zero growth on the lump sum, meaning if you just took it and shoved it in a savings account, the break-even a lot of times is somewhere around 15, 16 years, where you don't get up to that lump sum value out of the income stream for mid-teens, again, 15, 16 years. Then if you look at that relative to actually investing that money, right? You take the lump sum, you go put it to work, you earn a decent rate of interest on it. That break-even period extends out even further, 20, 25 years a lot of times. So you're running the risk, especially of an early death, right? Let's say that you take the income stream and then 5 years later, 10 years later, you pass away, right? You didn't really get the full value out of that pension that you could have had you just taken the lump sum up front. Now, the second one is counterparty risk. That pension is given by some specific company, some specific institution, could be Boeing, Microsoft, could be the state or federal government. Now, those ones are obviously going to be a little bit more secure, right? If you've got a federal government, you got a FERS or a PERS pension. But on a lot of those private insurers, maybe it's a hospital, maybe it's a tech company, you run the risk that that company adjusts the pensions, right? They start to have some financial difficulties. They say, hey, where can we cut costs? They either reduce or eliminate those pension benefits. A lot of the major car companies did this. Ford, GM, they had major slashes to their pension programs when a lot of people had essentially put their life savings in those. And so you want to make sure that you can control as much as possible the assets that are providing that income, providing that livelihood for you. Now, the third one is going to be liquidity, right? If you take the income stream, you do get that for as long as you live, but you don't have a lot of control over it, right? You get that monthly paycheck or that quarterly paycheck, but you can't take it any faster. You can't take a lump sum out of it. You can't also, from an inheritance standpoint, you can't take and pass that to your beneficiaries. It just dies with you. So there are some drawbacks to consider when looking at the income stream versus the lump sum there. So one of the things that's really helpful for our clients is seeing a side-by-side comparison. And we can just run 2 separate financial plans for you to say, okay, if you take the income stream, here's what the outcome looks like, both from an income and a longevity standpoint. Or if you take the lump sum, here's how that's going to play out. Here's how we would invest that for you. Here's what the growth rate looks like, the income. Here's how it's going to impact the inheritance for your kids or beneficiaries. Being able to see those numbers side by side is super useful. And again, at the end of the day, we just want to make sure that you're making the best decision, right? We don't want you to fall into some trap where you regret the choice that you made 10 or 15 years down the road. We want to make sure that you're going in eyes wide open with these important decisions around those pension options.
So you think about it, Social Security decision, when do you start it? If you're married, don't forget when the spouse passes away, the lower of the two Social Securities goes away. So maybe the higher earning Social Security counterpart, husband or wife, maybe should wait. But that's where Brian and Arrin and the team at Decker Retirement can walk you through every scenario and show you the numbers, show you the math. And now you're making an educated decision, but it's based on what you want, not what Brian or Arrin want. It's what you want. But they can show you all of that. Same thing with the pensions that Arrin was just talking about, lump sum or take the pension the way it was designed. Those are really big decisions, and it really just seems to make a lot of sense to me anyway, to sit down with a retirement planning team to talk about those choices that you have to make. They're big decisions, and they have obviously far-reaching ramifications for your money down the road. You need to make the right decision for you and your family. You have questions, you want to learn more, 833-707-3030, no cost for this, 833-707-3030. Might be the most important phone call you make, certainly today, 833-707-3030. All right, Brian and Arrin back for our final segment of today's Safer Retirement Radio right after this. Stay with us.
War involving Iran is driving uncertainty in the markets. The question is whether your retirement timeline can withstand it. Call 833-707-3030 to schedule a retirement review with Decker Retirement Planning. Call 833-707-3030.
Not only is it annoying, but that leaky faucet can cost you a lot of money. Do your retirement accounts also go drip, drip, drip? Even small fees can add up. Combine that with taxes, and all of a sudden, you could have a pool in your basement. Financial advisor Brian Decker and his team at Decker Retirement Planning can't help you with that broken faucet, but they can help you fix those leaky accounts so you're not paying more in taxes and fees than you have to. Decker Retirement Planning loves helping families just like yours reduce taxes and fees as part of their customized retirement planning process. Call now to see if they can help you too. To set up your visit with Brian and the Decker Retirement Planning team, call 833-707-3030. Don't let any more of your hard-earned dollars go down the drain. 833-707-3030. That's 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.
If you only think about taxes once a year, you're doing it wrong. To get the most out of your retirement nest egg, you shouldn't just file your taxes. You need to plan for them. Call Brian now to see what tax opportunities you could take advantage of. 833-707-3030. That's 833-707-3030.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. I'm Mark Elliott. Again, if you have questions, anything that the team has been talking about today, it's 833-707-3030, 833-707-3030. The topic today is building a diversified retirement income. So that's Social Security, that's pension if you're lucky enough to have one. It's also your investments. How do you pull from where, when, and how do you figure all that? Rental income. Maybe you want to work part-time just to kind of ease your stress level of having enough income month after month, and you like your job. You want to keep doing it. Well, that's an option, certainly. Dividend strategies, annuities, and guaranteed income. There's so many moving parts, but income is really where retirement planning starts. So, Brian, you guys are now moving into what, the investment portfolio withdrawals, trying to figure that one out?
Yeah, there's two very important parts on making sure as fiduciaries to our clients with a math-based approach, there's two critical components on how to properly construct the withdrawals of your portfolio. One is making sure that you're using compound interest to our client's advantage, drawing from the lowest earning accounts first, allowing the higher earning accounts to grow and compound. So for example, we just had an annual review with someone that's been with us for 5 years, started with 1.5 million. He's taken out 400,000 in the last 5 years, and he still has over 1.5 million. The way that we did that is we drew from the lower earning accounts, allowing the higher earning accounts to grow and compound more than offsetting what was withdrawn. So that is one part. The second part is tax minimization. So there's two parts to client portfolio. One is taxable, one is not. The taxable accounts are retirement accounts like the IRA 401k that are pre-tax. When you draw $1,000 out of an IRA, you're taxed on that income. The other is non-qualified, not retirement accounts. Those are accounts that are where they've already paid tax on it. When you drive up to bank teller and you pull out $1,000 from your savings or checking, you're not taxed on that. So what we do is we make sure that we use a strategy called placement. So what we do is we front load the non-qualified accounts up front so that a big chunk of that income coming in the first 5 years of retirement is already tax money. That gives us a window of about 5 years to do very important Roth conversions. Arrin, can you take it from there?
Yeah, absolutely. So again, the point here is really just making sure that you get as much value out of those assets as possible. And the interaction of all three of those tax types, the non-qualified, IRA, and Roth, is really important to both order it, like Brian was talking about, which tax type of money do you actually pull and spend first? But the second piece to that is where it actually gets invested, right? What investment strategy or what investment vehicle you're using for that money, because there's specific investment strategies and vehicles that are either more or less tax efficient based off the tax type of money that you're putting in there. So again, when we're outlaying what's going to go into buckets 1, 2, 3, 4, 5 in risk, we want to make sure that you've got the ranking order right, you've got the investment strategy right, that not only is it going to grow and protect that money like you need it to, but it's also going to be a tax efficient way to do that, especially for those of you that have done a really good job saving in those non-qualified or after-tax accounts. So maybe you've gone through, you max your 401k account every year, you've got a separate brokerage account that you've just adding money into, you got it in ETFs or stocks or mutual funds. The way that money gets put into the plan, the way that it's invested, the way that it's utilized over time will have a heavy impact on the amount of taxes that you're going to pay on that money. So again, both upfront and ongoing, we want to make sure that that's going to be in as tax efficient of a position as possible. So the next portion here that we wanted to shift into was around rental income for those of you that have rental properties. So rentals are a phenomenal way to both build wealth and to receive income. Now, we have a lot of clients that have had rentals for a long period of time. Maybe you've held them 10, 20, 30 years. And you're trying to figure out, what do I actually want to do with these in retirement? So first thing is, what is the long-term goal for the property? So we have clients that have a pretty heavy focus on legacy. They want to pass as much as possible to their kids or other beneficiaries. One of the phenomenal things about real estate is you get that step up in cost basis. So maybe you bought the property for $100,000, it's worth $1 million now. If you were to sell it, you'd have to pay capital gains tax on the difference between the market value and the initial purchase price. However, if you continue to hold that property until you pass, give that as a portion of the inheritance to your children, they get what's called a step up in cost basis, which basically eliminates that tax bill for them. So if they decided to sell the property right away, they'd get the full value of that in their pocket. If they decided that they wanted to keep it, continue that rental income, and eventually sell it later on, they've increased that cost basis from your original $100,000 purchase price to the date or the market value at your date of death. Say it's $1 million. So they've eliminated a huge portion of that capital gains bill if you wait until you're passing to transition that to your kids. Now, a couple of things to consider here, though, is what work is required, right? I always have to chuckle a little bit when people call rental income passive income, because if anybody's had rentals, you know that it's not always passive, right? You have your tenants calling you saying, hey, toilet doesn't work. I need an electrician to come out. Or, hey, this broke. Can you have somebody come fix this? You got to get new tenants when they rotate out. And some people don't mind that, just kind of par for the course as far as having rentals. Other people are like, look, I just want to make my situation as simple as possible. I don't want to worry about this. I don't want people calling me. I just want to make sure that I have the income and I get to go off and do what I want to do with my time. So really thinking about what's highest on the priority list for you in retirement, right? Do you want the income? Do you want to focus on inheritance, getting that step up in basis? Or do you want to simplify your life? Do you want to sell those properties, pay that capital gains tax, get that working for you in the financial plan that we build for you, not have to worry about the ongoing maintenance or management?
Hey, Aaron, I just want to add on the real estate portion for rentals, there's a strategy that we use for clients where the rental income, we help them create a tax-free stream of income by using some easy strategies. So that's important in cutting taxes as much as possible. Roth conversion you mentioned is so important. So when it comes to rental income, we help many clients with an easy strategy to have that be tax-free. That's something that a lot of clients call into and we chat about. The other one is capital gains. If someone has a very large capital gains exposure in real estate, selling a business, stocks, there's strategies that we can eliminate or greatly reduce the capital gains tax as well. So that's something that's really important. Tax strategies, minimizing the government in your wallet is something that's really important in retirement planning. So when it comes to strategies, when it comes to using strategies that can minimize the tax that you pay on your IRA, the tax that you pay on your capital gains, there's strategies. If you've got living parents that are old, it's called upgifting, where you can move funds up to them and gift them heavily so that when they pass away, it comes back to you with a stepped up basis. There's donor advised funds that we can use to help people minimize the one-time hit in a tax year. If they have a large spike in income, we can use donor advised funds to minimize that. There's many ways when it comes to taxes that we can help clients. Also, lastly, Mark, I know we're running out of time, but lastly, in state or federal estate taxes, I would say half of our clients say, hey, I'm dead. I don't care. The kids can pay that. The other half say, nah, I've paid taxes all my life. I'd roll over in my grave if I knew that Uncle Sam would reach out and take another 20-25% of my portfolio on estate taxes. I'm not going to let that happen. So there's strategies that we can eliminate or greatly reduce the state estate tax, for example, in our markets in Washington state, or the federal estate tax in our other markets. One last thing, Mark, is trusts that our clients fund our grandchildren's college education. So there's a lot of tools that we can use in retirement planning.
So you think about it. Income, where's it going to come from? How much do you need? How long is it guaranteed for you? I mean, there's a lot of things you have to think about. And certainly income is where it starts. There's also investment strategies, tax planning strategies, healthcare, long-term care, legacy planning. Then you throw in Social Security and Medicare decisions. There's a lot on your plate. And the team at Decker Retirement is here to help you figure that out. A math-based firm, as Brian always says, comes down to math, but sometimes your brain or your heart says, heck with the math, I'm going to go with what I want to do. Well, that's certainly your option. It's your life. It's your money. So if you'd like to learn more about your situation, try to figure out where you are. Are you in the right place? Do you need to make a tweak here or there? Have a conversation with the team at Decker Retirement. There's no cost for this. 833-707-3030. 833-707-3030. 833-707-3030. So Brian and Aaron, always appreciate the time. Thank you for listening to Safer Retirement Radio with the team from Decker Retirement Planning. Have a great weekend. We're back with more next week. Same time, same place. Have a great weekend.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Remember that first paycheck when you started working all those years ago? You looked at the net amount and thought, whoa, what happened here? Ah, the joy of taxes. It could be this way with your retirement accounts. You know how much you've saved, but if you haven't planned for Uncle Sam, you could come up short in retirement. With tax laws constantly changing, there's a lot you need to know to make sure you're not paying more than your fair share. Financial advisor Brian Decker and the Decker Retirement Planning Team can help you create a plan that shows you how taxes could affect you now and in the future. Set up your tax strategy session with Brian and the team at Decker Retirement Planning now. Call 833-707-3030. That's 833-707-3030. Make sure you know how these changes could affect you so you can avoid some of those whoa moments in retirement. Call 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk, including the potential loss of principal.